Google stock, the only video you need to see. Welcome back to our YouTube channel Shareholdr. In today's video, we are going to talk about Google stock and everything you need to know about Google stock. Alphabet Inc., better known by its former name Google Inc., is a technology conglomerate that oversees a number of companies, including the world's largest internet search and advertising service, the popular streaming website YouTube Video, the mobile operator's Android system, cloud storage services, and other assorted growing companies. Practically synonymous with online search engines and the internet, it has even become a verb. To search for something on Google means to search for it on the web. The California-based company processes billions of search requests every day and is among the most visible and recognizable private entities in the world. Although the company has risk interests in a wide range of internet-based industries, including email, social media interests, and video, analytics, robotics, and many other areas, internet search remains the main driver of sales and profits. Google is one of the most successful stocks of the 21st century, launching at just over $50 per share in August 2004 before reaching a value in 2019 of just over $1,125 Class A per share value. Despite its non-dividend status, investors of all kinds have flocked to Google and helped turn it into a $66 billion company. What are some things investors should know before deciding whether to go for Google? Google's co-founders, the company president, and a few other directors own the company's B shares, which are not publicly traded. Google split its shares in April 2014, creating A shares and C shares. The division doubled the number of Google shares and cut the price in half. But the important difference is that Google shareholder A gets 1 vote per share and shareholder C gets no votes. Shareholders B get 10 votes per share, which means they have the majority of Google's voting power. Google's A shares have been traded at a small premium over its C shares, demonstrating that the market prices have some value on voting power. The bottom line is that Google allows investors to buy large shares of its capital but gives up little control. Investors interested at Google who want to vote at its shareholders' meeting should go for A shares. Regulatory risks. This is not to say Google doesn't face challenges. Governments like to regulate things, even if sometimes it takes a while to get started. This pattern is evident in today's internet industry, particularly for conglomerates like Google, Amazon, and Meta. The whole debate over net neutrality and the Federal Communications Commission's 2019 decision seems to be specifically targeting Google's competitors, such as Verizon and Sprint, all under the auspices of internet equity, but Google could be next. Having installed more than 100,000 miles of fiber internet service provider around the world, the company makes a significant contribution to the internet infrastructure. Net neutrality is a slippery slope. The Federal Communications Commission regulates radio and television content, essentially limiting the services that communications companies can provide to their customers and shareholders. Federal regulation of internet speed is the first stage of Google's regulation of content, search engine results, and advertising. Google may find itself fighting the US government for control of its business. This is already evident on an international scale. In 2015-16, the European Union sued Google for manipulating search results to promote their shopping sites. Facing billions in fines, Google could join the likes of Microsoft and Intel among the companies the EU successfully targets. The Indian Competition Commission filed similar allegations in 2015, accusing Google of abusing its dominant position to manipulate search results. The fining system in India depends on income, and Google faces a fine of up to 10% on all revenue, which equates to billions of dollars. Underwhelming diversification. If a company grows enough, it runs into problems of scale. Larger companies face massive infrastructure, compliance requirements, staffing issues, and relative rigidity than their competitors. Google may find itself unable to generate more and more revenue through traditional means on a consistent basis, resulting in lower multiples for investors. In a letter to shareholders in June 2015, co-founder Sergey Brin highlighted the so-called moonshots that Google is doing. These include major capital investments in self-driving cars, Google Glass, biotechnology, and artificial intelligence. Most of these projects fall under the operational jurisdiction of Google X, a high-tech laboratory focused on futuristic experiments. Brin and CEO Larry Page have previously warned Google shareholders that the company wanted to be unconventional. Short-term gains wouldn't always be the center of attention, they said, because the future of future innovation is too exciting. It's a great sentiment for customers, but it raises alarm bells for investors. Shareholders could see a plateau of returns if Google focuses on unproven, underperforming companies and less on generating efficient revenue. There is a chance that Google may be successful with one or two innovative products, but there is always a chance that it won't. So far, Google's more realistic attempts at diversification have produced modest results at best. Google Plus was supposed to be an exciting response to Facebook and LinkedIn. By contrast, Google Plus has hundreds of millions of members and very few businesses. Google Glass didn't perform any better. Google's formidable moat. Stocks that have a lasting competitive advantage are safe investments and have moats. Examples of trench industries include cable companies, given the high cost of building new cable infrastructure, or Coca-Cola, which has an iconic name among consumers. Google certainly has a moat on the internet. This is perfectly impressive given the rate of change and intense competition on the web, the flat structure of which means anyone can create a competitive service. However, Google was able to gain and maintain dominance by providing better results at faster speeds than its competitors. Additionally, it has been able to solidify its market share with its Chrome browser and Android operating system and pay Apple to be the default search engine on Apple devices. Billions of searches. Over 3.5 billion searches are performed on Google every day. Each search generates a small amount of revenue for Google, as the company sells ads based on these results. Google owns 75% of the internet search market and 85% of the mobile search market. Furthermore, internet search continues to grow as it becomes an integral part of people's daily lives globally. A huge profit engine for the company, this is the main ingredient for making Google a safe investment. Nearly 90% of Google's profits and revenue come from search. These profits and revenues finance projects that Google hopes will become future profit centers. It allows the company to take huge risks that other companies might not consider. Additionally, the search has provided Google with huge war booty and lending capabilities that allow it to buy any competitor before it becomes a serious threat. The ubiquity of your search product also ensures the algorithm continuously evolves to deliver better results to users. The more people use Google Search, the more data is collected. Thanks to these inherent advantages, Google is in a much better position than its smaller competitors and can withstand the competition and stress of economic weakness, and it has a history of doing it. Mobile apps replacing search engines. In terms of mobile access, Google is lagging behind its competitors. Apple generates a lot of revenue from mobile apps, whereas the place to be more and more consumers use mobile devices. Traditional search engines, aka old web browsers, generate most of Google's advertising revenue. Whenever a mobile user clicks on an app instead of using a search engine, Google advertisers lose potential access. Smartphones don't have to go through google.com to shop, travel, or find restaurants. Google used to be the gatekeeper, but there's a big new door for mobile users to travel through. Google can compete in mobile access, but it doesn't have the same overwhelming advantage over Apple and Facebook as it did over Yahoo or Bing. Google shareholders will eventually feel this pressure unless the company can generate other types of income. Tell us in the comments section your view on this topic. That's it for today's video. If you like watching our content, please consider subscribing for future uploads. Thanks for watching.